And yeah, you'll see that the bid-ask spread is a little wide. It's about 6 cents. If you look at the 138 call for the spiders, it's 6 cents. But this is not going to be the case when the market opens. You'll see that the bid-ask spread is about 1 cent, at the most 2 cents for the spiders. So if you wanted to buy an option, this option, the best way to get filled is to pay the seller what the seller is asking for. So in this case, the seller is asking for $2.04. So if you're willing to pay that, then you will automatically be filled right away. But why do you want to pay the higher price? So let's just try to put this into the order screen and see what happens here. So if I put this order in now, I see that there is a mid price, and this is the Thinkorswim platform, but I'm sure all other platforms also have similar implementations. So we see that the natural price is $2.04, and that's exactly what we saw. That's the lowest price that a seller is willing to sell it for. And the mid price is 2.01, and the bid price was 1.98. That's what we saw. So that's somewhere here. So in this case, if we choose the mid price and say we wanted to get this filled at 2.01, in most cases, you should get your order filled. In somewhat rare instances, if the security is in great demand, the market maker may not give you a fill, and you might have to jack up your prices by 1 cent or something. But this is the spider, and that's why it trades in 1 cent increments. Let's look at the SPX, which is the larger index, the S&P 500 index, and you'll see that this does not trade in 1 cent increments. In fact, so if you look at an at-the-money call option on the SPX, you'll see that the bid-ask spread is very wide. In fact, you can see that this option, the mid price is $17.60, and the natural price is $18.80. So that's one of the things you have to watch out for, because this is a huge difference. If you're buying 10 contracts, which is 1,000 shares, the difference between buying it at $17.60 would be $17,600, whereas this would be $18,800. So you're talking about $1,000 difference in your trade entry price itself. So I think it should be pretty clear that we have to be very watchful of what these prices are. Now, granted, you cannot get away from the bid-ask spread, because that's how market makers make their money. That's one of the ways market makers make their money. They have a couple of different ways to make money, and this is one of them. So you're not going to be able to get away from it. You're going to have to give market makers something so that they give you a fill on your trade. But your goal as a private investor is to minimize what you have to give.